Now, Jack, if today's numbers are useless, what are the numbers you sort of look at in trying to evaluate the marketplace? Is there any indicator? Is there any gauge? Is there anything out there that you're following or monitoring from a big picture macro perspective more than others right now today in June 2009 in what some deem the epicenter of the housing crash in the U.S.?
The days of buying real estate based on future appreciation are gone for a while. And you have to look at it that way. So if you are planning on buying real estate as an investor, you have to cash flow it. You have to be able to do a positive cash flow. Or at the very least, if you're breaking even, this has to be a really desirable opportunity that you think, for a great variety of research you've done an investigation, it's a stable building. People, 90% of the people live there and they've only had 10% of the units available for sale. There's good cash flow to cover. It's stable. There's reserves in the homeowners. You really have to do your research. We've got buildings right now that are turning up with Chinese drywall. It was only in single-family homes at first. Now we're finding that it's also in condominium buildings. These are going to present great stigmas, and it doesn't matter how good a deal you got on that. If you got 70% off, you're going to lose money. So there's tremendous amount of risk that's out there in investing right now. So I think when you look at an investment, if it does not pencil out, if you cannot cash flow it right now, and there are strong reasons for why you're going to be able to charge that rental rate in the future and potentially realize some additional appreciation based on value-added money that you're going to put into it, it doesn't make sense. It just doesn't. So we've seen some vulture buys. I thought last year that guys thought they were getting great deals on. They're now finding aren't worth anywhere near what they paid for them. There's opportunity, and for those of you that know me and have read what I've said in the paper for 5 years now, I've said it didn't make sense to buy. It made sense to rent, and that has held true, I think. Now I would tell you that I think there are some deals out in the marketplace now that do make sense to buy, but they're rare. You really have to do your research to get into them, and whether you're an individual investor looking at individual units or a few units, or you have a nice war chest and you're going after projects or portfolios, there are some deals that again make sense, but it's not a time where you can just write a check, throw it across the table, and be guaranteed you're going to make money off it. Now you really have to do your investigation before you do. And so anyway, I think there's opportunities that are presenting themselves that you can cash out. Like I mentioned, some of these condo conversion units that you can buy for $50,000 and $60,000 in certain buildings. You can rent those out and do a positive return with the opportunity for some potential upside at a later date. But you want to make sure that you take care of business and that you don't get in over your head and that every asset is yielding income to you. There's a lot of people right now that bought one speculative condo unit in 03 and made money, and then a few more in 04 and made money, and then a bunch of them in 05. And then had a big portfolio and got stuck with them and lost it all. You don't want to find yourself in that position after all that hard work. So if you cannot make a deal cash flow. I know a guy that bought single-family home sites from public home builders last year. He knew they were going to have to dump them. They were going to have to shed all this. So he targeted specific neighborhoods and specific areas in Florida where all the home sites were in, they all had their infrastructure in, and he felt they presented the best opportunity for the lots that builders would demand once there was a reason to build again. Now realistically, he's thinking that could be 5 years from now. But he bought what amounted to builders cost $100 million worth of lots for about $12 million. Now, even if that land 5 years from now is only worth a third of what the builders paid for it, he's still going to triple his money. Now that to me was a very smart, because there's very limited maintenance he's got on this. It's basically a mothball kind of deal. You just pay your taxes, you put a fence around if you need to. That was a golden opportunity. He was very smart and sophisticated. He targeted his investments. That's what you have to do now. It's not just scattershot. You can't just show up at a condo auction and think you're going to get a great deal only to find out that a third of the building's in foreclosure and half of them aren't paying the homeowner's dues, and you may be faced with what could be an $8,000 special assessment or a $10,000 special assessment, or that your homeowner's dues could go from 50 cents a square foot to $1.20 a square foot because people are not paying, and then there's no way to cash flow. So you have to be very savvy with your investing, but there are opportunities out there.
Now, Jack, following up on that, in terms of the opportunities that are out there that appear to be good value, what type of return, or can you elaborate a little bit about the type of return that you would deem to be something that's kind of make some sense or could make some sense? Obviously, the location, the quality, all that's going to be important, but strictly from a numbers perspective, I mean, are these funds looking for break even? Are they looking for 5? Are they looking for 25% on their money? What exactly do they want?
The funds that I deal with, I'll tell you a typical deal, okay? A typical deal is where the fund puts up 90% of the dough and the sponsor puts up 10%. They look for a return of what amounts at the end. You're going to have operational. They're going to look to make sure you can try and cover your bills. You have reserves set aside if you can't. What they're going to look for is return of capital, a 10% preferred return per year, and then a split of the profits, and it can be anywhere from 50-50 to 20-80, or it can be a sliding scale. That's pretty typical when you deal with a hedge fund. So it's very difficult to make those numbers work, and like Alan said, right now almost everything's out the window because the best laid pro formas and business plans by the smartest guys in the business haven't panned out over the last 5 years. So to me, the funds are looking for that. Now, from an individual investor standpoint, I think what you have to be looking for is that you can, what your income versus your expenses are, that you can do at least a better return than what you can in some other type of very secure investment. To me right now, that's probably somewhere in the 7 or 8 percentile range. I'm looking for the opportunity at a payoff at a later date, but if I can't do 7 or 8% on my own money, it doesn't make sense to get into it because there's too many things you can put your money in that's safe without risk, without taking on those type of responsibilities. So that's kind of how I look at it.
Interesting.
If you can do better than that, and there are deals out there where you can, and like I said, I think there's going to be some deals where you may buy, and 5 or 7 years from now, you may double your money. You may do better than that. But you have to be, and if you're going down and you're going to compete with the big boys down in downtown Miami here on these condos, I got to tell you, I've been talking to them for the better part of 3 years now, and I mean over 100 of them, and it's from high net worth guys to the biggest hedge funds in the country, and all 4 points on the compass, and they've all had their MBA guys from the Ivy League down here hitting the bricks and talking to bankers like Raul, who are trying to get in to talk to them, and the strategic asset guys, and they're tired of talking to them. They don't even return their phone calls anymore. These guys have been down here trying to set up and establish contacts. So if you're getting into that kind of mix, it's very difficult. It's very difficult to compete. To me, if you're a smaller investor, you're better to stay under the radar, under what their economies of scale would dictate that they'd get involved in.